Let's examine how volatility affects individual, stocks and sectors. How does market volatility affect individual stocks and sectors in the market? So, in this video, I want to look at you know, the impacts of volatility on individual stocks as well as on sectors in the market. Number one is increased price fluctuation. When it comes to individual stocks, volatility tends to have that particular effect of increasing price fluctuations. So high market volatility, leads to larger price swings on in individual stocks, even for companies with strong fundamentals. Strong fundamental still, volatility still affect this class of stocks. So, stocks on high growth sectors like technology may experience more dramatic movements due to market sentiments. The market sentiment guides stock movements. Apart from company fundamentals, sentiments equally play a role on how stock prices behave in the market. Number two is high risk for speculative stocks. Higher risk for speculative stocks. Speculative stocks, such as small cap or penny stocks, are more sensitive to volatility, with prices, often experiencing, wild swings. They kind of swing or fluctuate wildly. So investors in these stocks may face, relatively, large losses, during volatile periods, but also, higher potential rewards. So there's that particular there's that particular tendency to, to have, to obtain a higher reward or higher returns, and as well as you could equally sustain a larger level of losses. Number three is earning surprises and guidance. Earning surprises and guidance. So stock prices may react strongly to earning reports, or forward guidance, amplifying the effects of market volatility. Usually, whenever companies, produce their quarterly results, investors react accordingly. If it is positive, they react accordingly. If it's negative, they equally react accordingly, leading to, swings in the market, amplifying, market volatility further. So positive or negative, surprises in earnings can result in a sharp upwards or downward price movement. If it is positive, investors will pile in, the stock price will rise. If it is negative, investors will then, sell off their positions and the stock price will drop. By so doing, they tend to introduce more volatility into the markets. Number four is an impact of news and sentiments. Impact of news and sentiments. So news events such as product launches, management changes, or regulatory news can cause volatility in individual stocks. Market sentiments driven by either fear or optimism, or pessimism or panic or euphoria over joy, can further, exacerbate, stock price movements. So all these factors will then, one way or the other, introduce volatility, in individual stocks in the markets. We want to look at, the impact of volatility on specific sectors in the market, so specific industries in the stock market. Number one here is cyclicality and volatility. Cyclicality and volatility. You have the cyclical sectors These example include consumer discretionary, industrials as well as materials. So these sectors are cyclical in nature. These sectors tend to be more volatile during economic cycles. When market conditions are uncertain, cyclical stocks often experience larger decline or gains. So depending on market sentiment, depending on the economy, you know, the performance are like cyclical in nature. So you have defensive sectors. Examples are utilities, healthcare, as well as some consumer staples. These sectors are more resilient to economic cycle because whatever happens, people will always, want to have amenities, want to have lights, power, gas, water, electricity, in their homes. And whatever happens, people people whenever they fall sick will still, access medical treatment. So this particular sector is kind of defensive, and that's why they are less sensitive to volatility. Number two is sector rotation. Sector rotation. In times of high volatility, investors may shift their focus to defensive stocks, reducing exposure to more volatile growth, focus sectors. Whenever there's an increased volatility, investors become kind of risk averse, become more cautious, and will shift their investment to sectors that are less prone to volatility. For example, during economic downturn, sectors like utilities and healthcare may outperform, while sectors like technology or consumer discretionary may face declines. Number three is, before then, please subscribe to this channel and like this video. Number three is interest rates sensitivity. Interest rate sensitivity. Volatility, related to interest rates, changes, usually whenever there's interest rate changes, generally it will produce volatility, and this will impact different sectors differently. So when it comes to the financial, sector, example banks can benefit from rising interest rates, while real estate or utility may struggle due to, higher borrowing costs. So the banks are enjoying because of increase, kind of borrowing costs, while real estate or utilities may not really do very well in this condition. Number four is commodities and energy. Commodities and energy sectors. Volatility and commodity prices, example oil and gold, affect the energy sector. While rising oil prices typically benefit energy stocks, while falling prices may hurt them. Whenever there's an increase in oil price, international oil price, you discover that energy stocks would experience an increase in prices. So energy stocks may experience more volatility during geopolitical events or supply disruptions. Like now, there's this particular problem in the Middle East, where the Houthis are targeting the shipping lane there. It might, one way or the other, affect shipping cost, particularly for tankers, shipping crudes along that route. Number five is technology sector sensitivity. Technology sector sensitivity. So growth-oriented sectors like technology often experience high volatility as they are more sensitive to market sentiments and interest rate expectations. So a rise in market uncertainty can lead to more significant fluctuation in tech stocks, especially for those with high valuations. So understanding how volatility affects individual stocks and sectors, will go a long way in assisting investors navigate markets fluctuations and tailor their strategies accordingly. So market volatility will certainly affect, both individual stocks and different sectors of the market. It's left for us to know precisely how these effects will affect our investments, and then be proactive on the strategies we adopt to mitigate them.